Hello again, and welcome to another exciting edition of Talking Real Money. I'm Don McDonald, along with Tom Cock over there in the corner doing whatever the heck it is he does. Just step back into frame. We're not in the same place. I'm in Florida, Tom's in Washington, and this is our radio show and then future podcast, but it's unique.
Well, and we've never done I don't think we've ever done this doing a pre-recorded radio program.
I think we've done it once.
Oh, okay.
I think we've done it once in the past.
We have been very good. I got to give us credit. In doing this for decades, we have been pretty good about showing up every day. I mean, we've showed up, 2 days after Thanksgiving. We showed up Christmas Eve. We showed up New Year's Eve. We showed up on every major holiday. We are here for you. But today, because I'm gone, we're not.
And
so
I'm
sorry.
gone too. See, that's the thing.
I didn't know that part.
No, I'm in New York.
Ah, you're in New York, and I'm in Puerto Rico.
I'm in New York visiting my daughter because she keeps saying, Dad, come visit me in New York. And I always go, I can't. I do a Saturday show. So she finally said, do it anyway. So I'm going to New York. I'm in New York. I'm in New York. Wow. How can I be in two places at once? I don't know how that works. AI. So welcome to Talking Real Money. I'm Don. That's Tom. We're not taking your calls, so we don't need to give out our phone number, although you can call us other Saturdays at 855-935-TALK. Today we want to talk about, a problem that has existed since the beginning of investing, and that is, where do you get the help you need, and how do you avoid the legion of terrible financial advice providers who desperately want to get their hands on your money? How do you keep them from basically taking advantage of you and taking a big chunk of your money?
Yeah, and we'll try to get to the case of a family member that faced this recently. But this comes from an article at one place you probably should not look for any quality advice, and that's called CNBC. So that would be the first thing.
At least
is
not
turn
on a
that
regular
off.
basis. Yeah, turn that off. But this is written CNBC. So
it's actually decent. The title is 4 Red Flags to Look Out For When Choosing a Financial Advisor, and 1 green flag. And then I added in my things that
there's a green flag.
There's a green flag, and I added in my yellow card for things you shouldn't ask an advisor if you're thinking of hiring them, because I think those are important too. So you got your red, you got your green, you got your yellow, you got your whole bit. But okay, these are from CNBC. These are the things they say that are red flags, and that is, and I think they're right about this one. When you go into a meeting with a financial advisor and the advisor does all of the talking, it's a bad sign. I mean, when you get into a meeting and they tell you all about, well, look, I did this, or here's what the future looks like, or I've got this great product that solves all of that sort of thing. That really is a red flag, because you're right, Don. What it should be an experience where you, the client, are doing most of the talking. The advisor is listening and thinking about the best things that could be done for you down the road. It doesn't mean they need to have an immediate answer. In fact, if they have one, that makes me even more nervous. Like, well, because here's what you have to do today. And many people have that. It's called product sales. And you really don't want to be working with anybody that's in that business, because the advice is self-interested, it's expensive, and it's not where you want to end up. It's generally not fiduciary advice. So I love that first one. I really do. The financial advisor does most of the talking. and in my meetings, sometimes I joke and say, I'm supposed to be quiet now. So I'm going to listen.
And we're all waiting for that day.
It's coming. I guarantee it.
Hope
sooner probably than later.
One of these days, yeah.
What happened to Tom? Really good listener.
Anyway, go ahead. What else you got?
Well, number 2 is, and this is very important, and people do try to obfuscate around this because in many cases they're embarrassed about it, and that is the advisors that will not be transparent about how they get paid. How much they get paid, how they get paid. Is it commissions? Is it fees? Is it fee-based? Is it fee only? It's very confusing. And many people say, don't worry about that. That's when you really should get worried.
That's the worst answer, and that's the one you'll probably get the most. How much do you get? How much do you get paid? How much am I paying you? What's the commission? Don't worry about that. The company pays me. Well, yeah, the company pays me, but where does the money the company pay you come from? And that's one of the biggest problems in this industry, is the lack of clarity, of true honesty. It's not that they're outright lying. It's the lie by omission, that they fail to tell you how much they might make on this is particularly prevalent, as Tom alluded to with his family member, in insurance product sales. They're the kind of folks who really don't want to disclose. You go to one of those free lunches or free dinners and you ask them what the commission is. They'll tell you there is no commission when in fact there is. We'll be right back in just a minute talking real money. How do you know when you're working with somebody who's acting in your best interest? How do you find good advice? And what are some of the warning signs that maybe the advice you're getting ain't so good? Tom's got a list right there that I think you got from CNBC, right?
I did. That would be the first red flag. Don't watch CNBC. Sorry, CNBC, but that's not a good place to get good long-term advice. The number one, according to this article from CNBC, is the financial advisor does most of the talking. I think that's a red flag. Number two, we mentioned briefly, the advisor's not transparent about how they get paid. Now, if you call me and say, look, I want a little advice, I give people an hour. I tell them that regularly. I'm not going to charge you for that. And we review your portfolio for nothing. People see it as a come on, and it is a bit of a come on, I guess, because
no, it's not.
But it is, because if you want to, after looking at that, say I want to continue and hire you, sure, that does happen.
Well, then you got to pay us.
Yeah, then you got to pay us.
No, but really, okay, let's talk about that, because these free consultations that these guys offer all the time, they're a pure sales pitch. When you have a meeting with somebody who listens to the show, you're not going to give them a sales pitch.
Nope.
And our other advisors who are part of this program, they are not going to either.
That's
true. It's not about pitching you. It's about helping you, because we found something really interesting. If you help somebody, even if they don't hire you, they often tell their friends and family members who also need help.
That just taken us from $1 million that you and I started with here 15 years ago to over 1.1 billion today. So can we say that like McDonald's, 1.1 billion served?
$1.1 billion
served up. Red flag number three. This is important, and this is something that we've really worked hard on the show to help you understand how to find this out. And the article says they're talking about advisors, transparent about their background and credentials. Now, you've done a great job, Don, over the last decades talking about how you can go to Broker Check, right? And can you check on everyone at Broker Check?
Everyone at Broker Check. Okay. Well, everyone except insurance licensed
I was getting
people.
To that. Yeah, okay.
So if it's somebody who just sells insurance products, they're not going to show up there. And there are a lot of those who call themselves financial advisors, but they work for New York Life or Northwestern Life or whoever it might be. And they're not going to show up. If they don't show up there, that's a red flag.
Because they're not even licensed.
They're not even licensed with the SEC or FINRA.
Yeah. And okay, so go back there. What you want is a fee-only 100% fiduciary, not duly registered. So they'd be only registered as an investment advisor representative of an registered investment advisor, IAR of RIAs. That's what you're looking for. And by the way, that does not guarantee, I hate to say it, because you just ran into this the other day. That does not guarantee that how do I put it? That their portfolios are of a high quality. We just ran into somebody.
It doesn't even mean they're good at what they do. It just means
eliminates
they're licensed.
A lot of the
It
bad
just
stuff.
means that they are being regulated by either the industry, which is FINRA, or by the Securities and Exchange Commission, which is part of the U.S. government.
Yeah, but it doesn't mean they're going to. So we have one where somebody came in and they were being paid, the advisors being paid 1.25% a year. And then we looked at the mutual funds they're in. They averaged 1%. So this person's paying 2.25% a year for that help. And they're not getting any planning advice. I mean, that's not really
that's
very
a wealth
good.
suck.
That really is. And you don't see it every day. It's just gone. Red flag number 4. It's kind of funny, but you don't trust them. It says, if you don't trust a potential advisor or have a gut feeling that they aren't right for you, it's okay to move on. Really? Is this the Department of Redundancy department? I mean, come on.
That should be the number one. I don't trust you. I'm
walking away. It says you walk away from meetings with your advisors feeling informed and confident, not intimidated or bewildered. Yes, that's true. You should be able to walk out there and go, here's what they were telling me, and here's why it makes sense.
Oh my gosh! Speaking of intimidated, when I was a young broker, my boss was a broker who intimidated the hell out of his clients.
He's the one who ran through the office yelling.
He yelled, he screamed
Wow.
at clients. What are you, stupid? Oh
Wow.
my God, he would just berate them until they would give him business. They would like, okay, I'm sorry. I actually, because I sat in the bullpen when I first started until I got my office, I actually went to an Army surplus store and got a World War II helmet.
I thought you were saying World War II hand grenade just in case.
No, I got a helmet because he would throw stacks of prospectuses at us.
You better know this, right? Or you better sell this, more importantly.
Or get back on the damn phone.
Exactly.
Boom. And he would throw the prospectuses at you.
Yeah.
So intimidation is also a red flag.
Well, we see it all the time where people are going to leave the said broker and the broker calls up, how can you do this to me? How can you take your money? They still say these things to him, like, because it's my money and I'm going to do with it.
You don't love me
weird.
anymore.
Yeah. Those are good.
What else you got?
Well, the green flag. This is interesting.
Oh, you got a green flag.
This
That's
is good.
right.
And I've got a few suggestions of things you shouldn't ask someone or shouldn't be focusing on. The green flag is they ask you for your tax return. Yeah. A good advisor is going to want to know that because that's going to be central to the planning of the financial planning, retirement income, financial planning, all those things.
Because tax planning is part of a financial plan.
So I love that. And someone quoted in the article said, trying to do financial planning without looking at someone's tax return is like a doctor writing a prescription without first examining the patient. Which, and by the way, if you're a doctor, I'm looking for that doctor because there's some pills I want to try to get me through the holidays. So, can I say that? I guess not. Anyway,
you can say it because all of us who have known you for a long time know it's absolutely not true, unless, of course, it's a prescription for Ambien for you when you get on a plane.
That's true. And I still have a few of those rogue Ambien pills. How long do those last, by the way? So I think that's a good one.
Long enough for you to make it through the flight.
I got a few things you should not be focusing on when you meet with someone. This just came up last week because someone came in the office and wanted to chat about their portfolio. They've been self-managing, probably at a place in their life where somebody else really should be helping them. And they wanted to compare their 1-year return to our 1-year return. And I said, no.
That's a terrible idea.
I said, no, we don't do that. And we're not going to, and they were shocked. Well, what do I base it on? You base it on all the things, the aforementioned fee-only advisor, 100% fiduciary, the style of which the money's invested, sure. Low-cost index or index-style mutual funds or exchange-traded funds, broad diversification. That's fair, but doing a return comparison is not a good idea.
Were they a listener?
Yes. It turned out that the woman in the relationship was, the guy was not, and he was the one asking the question.
Because we tell people that really the best you can expect is the return of the market.
Yeah. Well, in this case, he wanted to see how he'd done better in the last year. So, number 2 that you shouldn't focus on, this comes up, you mentioned at the beginning of the hour, fancy lunches and fancy offices and fancy pants. People are impressed by that. They buy all the time because of that. They see that. They think, oh, you must know what you're doing. Because
we do when it comes to interior decorating.
Right. Exactly. We have always taken the opposite approach where we try to keep all that pretty low key.
When we had an office in Phoenix, the whole office was outfitted from IKEA.
I remember.
The one in Bellevue was outfitted from Wayfair.
I remember when we went down and bought the stuff, the first one.
IKEA.
Yeah, exactly. And number 3, you should not be focusing on anything that they supply you regarding predictions, regarding here's how great I've been. I mean, all this hot, bloviated air you get, that's a problem as well.
And we're going to take a quick break because we have to. It's radio. And then we'll be back. Let's talk about Tom's family member when we get back, shall we? Come on, money doesn't get much more exciting than this, really. Come on. The Talking Real Money podcast, it is the only money show you really should be listening to. Well, there may be a couple of others, but there aren't very many. Most of them are, as Tom said earlier, bloviating bad advice. Bad bunnies. Oh, wait. No, that's a rapper.
A fellow Puerto Rican of mine.
Are you really meeting Bad Bunny when you're in Puerto Rico?
I think he's going to be there with the mayor when we're in town. So we'll see.
Really? Yeah, you're so full of it.
I don't think Bad Bunny.
I don't think so.
No. The mayor.
You don't even like rap.
I will send you a picture of the mayor myself.
And Bad Bunny?
And Bad Bunny.
or it's just some guy dressed up in a rabbit costume.
Who knows, right?
I have no clue. Anyway, we were talking about bad advisors, and something just came up before we started recording this. Tom's brother was a teacher and
I think
had
he'd prefer to be called a professor, actually, but okay.
Professors teach, though, don't they?
I'm just putting it out there because if you met him and you called him a teacher,
he was a fancy
pants. Yeah, exactly. Yeah.
Okay, but of music.
Yeah.
So
you don't take him seriously now? Is that what you're saying?
Same. I mean,
I'm just a radio guy. You don't take me seriously.
You are just a radio. We don't take you seriously.
Okay, fair enough.
All right. I wouldn't call you a professor either. But he was approached by his kind of advisor for his retirement plan at the college.
That's right. The university, correct.
Yeah.
And so they looked at his situation, a portfolio, by the way, that yours truly designed for free because he's my brother. Or maybe that's the price of him being nice to me. I don't know. Maybe that's what he's getting his money.
Is he nice to you, though, really? I've been around when your brothers are around you. And
that's a good point.
Is that nice? Is that what that's called?
Compared to the earlier years, yes, that would be considered nice. At any rate, this advisor, I'm using air quotes here, suggested a portfolio update because my brother is in what he called a moderately aggressive portfolio. And maybe that's too aggressive for somebody whose income is less than it was and who will probably start drawing on the portfolio in a few years. So he looked at it and said, it's moderately. Let's fix that a little bit. The first thing he recommended was taking a third of the money in the account and immediately placing it in an annuity because that's what you do.
Of course,
it's so easy.
Suggested that.
That's just a no-brainer. I mean, you put it in there, you're going to
I'm smelling the sweet scent of a commission.
Yeah. Probably so.
Yeah, that's and I can smell it from here.
You're good at that. Then, in addition to the money that's still left in there outside of the annuity, selling off all small cap exposure. Don't want to own that anymore because that hasn't been good lately. I'm going to change that.
That's a good idea. Let's sell our losers. And what
exactly.
Does he want him to buy his winners?
Yeah, exactly. And part two of that is moving the international exposure from 24% down to 7% because that hasn't done well yet lately.
Sell the losers, buy the winners. Isn't that called buying high and selling low?
Repeat if necessary. I mean, but this is the kind of advice, and my brother's a nice person. He listens, and I immediately wrote him back and said, no. But he listens. This is not his area of expertise, right? His area of expertise is Bach, and this is not where he focuses on. So he asked me what I thought. I said, throw the guy out the window. I mean, because this is really bad advice.
But you see, what this points out so clearly is the state of most of and particularly when it comes to retirement accounts, 403Bs. 403Bs are particularly notorious.
Yep.
These are for nonprofits, for schools, for healthcare workers. 403B programs generally have some of the worst advisors associated with them of any plan. And I think both of us would agree that the best thing you can do is if your advisor from your 403B plan particularly contacts you to do something, don't do it. Whatever it is, don't do it without getting another opinion. And if you have a 403B plan and you've retired or you've left employment,
get it out of there.
Get it in an IRA.
Yeah, that's what another family member noticed and said, why is that money still there?
Why is that still in there? Exactly. Because it's the path of least resistance.
Well, and it's the way things go sometimes. It's just you got to get around it. Got to get around to moving it. It's harder. Yeah, I get that.
But actually in reality, moving it these days is so much easier than it used to be.
Wait, I mean, I can remember the days when you had to fill out actual paper and send it to the other place, and then it took forever. So anyway.
And we're going to take some questions. We got a lot more to talk about on this kind of weird edition of Talking Real Money where we don't take any callers, but we do have to sneak away for a few minutes. So please hang out right there. Talking Real Money continues. I'm Don McDonald. That's Tom Cock. You're there. We appreciate you being there for our radio show and our podcast. By the way, podcasts pretty much 5 days a week unless there's a holiday. I got to tell you, though, for Thanksgiving weekend, which is coming up like in a few days, we are going to take 2 shows off because both of us are traveling, doing stuff. So we're not gonna have a podcast on Thanksgiving or the day after,
Plus,
Thursday, Friday.
Turkeys get Thanksgiving off, so we don't have to work on Thanksgiving.
Right. But hey, here's the good news. Next week's show will include Tom sitting in this chair.
That's true.
Probably standing.
I'm
right
looking forward
next
to that.
To me
Live.
here in the studio. He's going to be in the studio.
Yeah.
Which mic am I going to let him use? I think I'll let you use the Neumann.
Am I gonna have a big club sandwich waiting from that great turkey from Thanksgiving right after that?
No, because we have no one. We're going to be gone for
You're
Thanksgiving.
worse
we're not
than
going to
I
be
am.
here. So
Okay, I'll have to
so
go
we're
buy
gonna
my
eat
own
turkey at a restaurant.
I'll run down and see Walt Disney. He'll give me a turkey sandwich.
Right. He's still alive. Sure. His head's frozen. Anyway, recently I was going through my emergency money accounts, and I have my emergency money accounts in places like Bread Financial,
Bread,
Marcus Bank, and my you know what I do with my Apple Card? I turn all of the cash back. It all gets put in a savings account.
How do I get the money out of there? I have money in that. I don't know what to do with it.
You just go to it and transfer it.
Okay, I got to figure that out. It's been doing that for years, so
it's easy. So I got thousands of dollars in cash back sitting in and I was looking at the yields on them, and they're all in the 4s now.
Yeah, except,
and I think they're in the 4s because they already hooked me in, and now they don't have to pay me 5 anymore because you said they're still 5s.
I know, even though short-term interest rates, the Federal Reserve's overnight rate has come down twice this year and may or may not come down again before the end of the year. And by the way, and we're going to do another segment on this soon, mortgage rates, by the way, have gone way up. And we'll talk about the reasons why that is.
In a future podcast.
Pretty interesting. Yes. But yeah, you can still go to, this is from the Wall Street Journal, best savings account rates in November 2024. You can still listen to this. The Digital Federal Credit Union, DCU, on the first $1,000 will pay you 6.17%.
Okay.
First 1,000.
Thank you for on the first 1,000. Okay. Right. Come on. That's $6.
I know. Okay, here we go.
No. That's $6.
All right. Here
it's
we
like,
go. All right.
Dude, you tricked me.
I know.
$6?
All right. Well, hang on. It's not over. Andrews Federal.
I'll throw an extra $1 and make it $7.
Andrews Federal Credit Union.
Did you say Andrews?
Andrews, 5.75% on the first 1,000. On the
Andrew
first 1,000.
has his own credit union?
He apparently does. He got big.
It's probably
on
the
the first
base. Yeah.
$1,000, 5.75%.
Okay, I don't want to hear any more of these.
All right, how about this one? How about this one? Now, when I first read this, I thought it was Pig Bank, but it's Pi Bank.
How much can I get on $100,000?
I don't know. I think you can go to PI Bank and get 5.50.
I think that's pronounced Pi Bank.
I thought it was Pig Bank when I first looked at it, but maybe that's because
there's no G, so it would not be Pig.
Lending Club is still at 5.15%.
All right, I know why the reason they're paying so much is because they are trying to raise capital to lend out to people at ridiculously high rates.
Oh, okay. So they can afford to pay out more.
Right.
Ivy Bank 5%, and you got to have 2,500 minimum there.
Okay.
Bank of Dawn. What do you do? What are you doing these days for interest rates?
My bank is there.
I'm asking you. Is your chance to promote it?
I thought I had a bank. Which I was going to be very appreciative for, but I don't.
You do have a bank. You pay the bills. You're like me, the bank of Dad or Don or whatever it is.
Yeah.
Okay.
Right.
Yeah.
Well, it's just the two of us and the 2 dogs.
Don't say anybody else.
I haven't moved my other accounts. It's just I don't want to move them.
Okay, so
I've got all the logins and everything.
Fair enough.
It's just so they're 4 and change.
Exactly. So okay, here's the deal. These are gimmicky. That was the point of the piece, by the way. These are gimmicky.
Oh, I didn't
Thank
know that
you.
was the
I
point.
didn't tell you ahead of time.
News.
I was trying to trick you into being, reactionary. So these are gimmicky. These are pretty short term. And again, this always gets back to this. This gets back to something that we talk about regularly. Yes, you should have an emergency savings account of some kind, but then every other dollar should be properly invested in stocks, bonds. No, not crypto. I know it's gone to wherever, whatever, because anyway, for whatever reason, it should be in stocks or bonds. Many of you still think cash is an asset class. It is not. You shouldn't look at it that way in your portfolio. Your portfolio should be designed with those other 2 asset classes. and cash should only be for short-term needs. That's it.
I'm thinking about these rates, and oh my gosh, I got to take a break. Hold on. Let me mention this when we come back from the break. We'll be right back. Okay, before we left, I was thinking about these teaser rates. It's like you're going to get an extra buck a month, approximately, about a little less than an extra buck a month over what you
Don't
could
be
get
so
at the
pushy.
5%
A dollar's
places.
a dollar.
Okay?
Come on, man.
But I was thinking about it for a minute. I'm going, all right, every once in a while I go to McDonald's for lunch, and I have the McDonald's app in my phone, and I order through that, and I get like 20% off.
Do you really?
My meal?
Wow.
Yeah, if I order through the app, which is like $2 off.
So there's your $2.
So I actually do better. I make more money with the McDonald's app than I would opening an account with one of these banks that pays $60
on the first
a year
$1,000.
on
$1,000. Yeah.
I mean, it's a buck a month.
Okay. All right. Just putting it out there. I'm just providing them. Don't kill the messenger, man. All right.
I'm not killing the messenger. I'm just like, wow.
Silly.
People.
It's silly is what you're saying.
And
I
again,
think
I bet a bunch of people fall for it. There's oh my God, I'm going to make an extra $1.
No, they don't think about the dollar. They just see the 6%. All right. You want to take up a couple questions here?
Well, since no one can call us because we're not
they might
really
be
here.
calling right now, but we're not answering.
We're not answering.
Angie from Byron, Georgia says, thanks so much for being willing to help those of us who are trying to invest on our own. I do greatly appreciate the advice. Your advice is not to mess around with the strategy, and I try not to. However, I'm constantly learning.
I knew there was a but.
Constantly learning, and have decided that I agree with the strategy of AVUS, which I believe is the Avantis all U.S. market strategy.
All U.S., yeah.
Versus the FSKAX total market index. That's Fidelity's total U.S., right? Because she says, because they're more evenly weighted of all the companies rather than concentrated more into just the large cap companies. Yes, FSKAX probably holds a greater portion of it in U.S. large cap growth firms than AVUS, because AVUS, remember, is designed by academics who say you should own more small, more value, etc. Do you agree, she says, with this strategy, AVUS over FSKAX, in an individual brokerage account? And if so, would you sell FSKAX and purchase AVUS, or just keep it and in the future start purchasing AVUS? I'm 59, portfolio $250,000, own a house, have no debt, and make $5,000 a month, etc. Invest the rest. She has emergency cash fund of $10,000. Talked to Tom a while ago, got some great advice. How does this strategy hold up? So,
okay,
yeah.
Well, okay. Let me start with, why are we just talking U.S.? I don't know the rest of your portfolio.
Correct.
So I'm hoping there's some international somewhere in there, because I don't. I think you're making a big mistake if you don't have it. But from the perspective of better balance, oh my gosh, so much better. Let me just give you all
I knew you're going to have
example.
some numbers, yeah.
The Fidelity Fund, which is the total market, has 6%, a little over 6% in Apple, almost 6% in Microsoft, over 5% in NVIDIA, 3% in Amazon, and 2% in Meta.
Yep.
Okay? AVUS, which is a total market fund, it only has 4.6% in Apple, a little less than 4% in NVIDIA, a little less than 4% in Microsoft, less than 3% in Amazon, and just over 2% in Meta.
That sounds about like 12% in those 5 companies.
It's a much better balance to smaller companies, and they're de-emphasizing the big ones. That means in periods when the S&P 500 does incredibly well, AVUS is likely to slightly underperform. However, flip side, when the small companies markets or the mid caps they are doing better, the AVUS should exceed the growth of the Fidelity. And the good news there is that over 100 years, 99 and change, small cap stocks have dramatically outperformed large cap stocks. Why? Well, because they're riskier, they're scarier. But if you hold a whole portfolio of all these things, then there's nothing to be worried
Yeah,
about.
I mean, and by the way, Small has had a very interesting time here since the presidential election. You go back and look at the performance, which has been astounding. You should always have it in your portfolio. She does mention that she's got AVGE in her Roth IRA, but their question was kind of around, should she run out and sell everything and then buy the other fund? Well, no, because
Well,
the taxes.
I
Yeah.
was going to say the Fidelity Fund is you're
Right.
going to get hit with
You don't want to
taxes.
do that.
You got to do
no,
some tax
I think your
planning.
philosophy is correct, Angie. What you're going to do here is you're going to start buying the AVUS if that's the fund you're going to hold into the future. Leave the other position as it is. We don't want to ever just willy-nilly sell something, create a big capital gain. So sell that. Buy AVUS, and you're going to have both of those in the portfolio. Then, as Don's correct, you're going to want to pump up that AVGE, though, because you want international exposure because you have none.
Or just use AVGE in place of AVUS everywhere.
That's fair.
And get the better balance across the board. Did you know what? Typically, you'd think that Avantis, because of its fancier strategies, would be more expensive than Fidelity, right?
You would think.
Fidelity's expense ratio on that fund is 0.15. 0.015. And Avantis's is 0.015.
Wow. That does surprise me because those asset classes are generally more expensive.
More expensive, yeah. It really surprised me to see that they're these, and it's because of the ETF structure. If it was a mutual fund, it would probably be higher.
Yeah, I want to mention something that's important to consider here too. You alluded to it, but we didn't make it maybe clear as we should. If you had held a portfolio that had been more concentrated in those mega caps that made up, I think it was 12 or 13% of AVUS, the last 10 years, you'd have done better than being diversified.
Absolutely.
And that's one of the struggles people have. They're like, well, wait, it hasn't worked as well. No, but Don mentioned the important factor here that pretty soon, in a few months, you're going to be able to say we have 100 years of data that shows, yeah, it really does make sense to own small companies. It does make sense to own value companies. Those have been better performers. They're riskier assets correctly. You want to make sure you got plenty in your portfolio. When you own a pure index the way Fidelity runs it, you keep waiting, you keep throwing more and more money at these huge, huge companies, which really scares the heck out of me.
And think about this for a minute. Again, I want to go back to those 5 top holdings. As Tom said, the top 5 holdings in AVUS represent about 12% or so of the portfolio. The top 5 holdings in the Fidelity total market represent almost 23%.
Yeah, $1 out of $4
of the entire portfolio.
That's massive. Yeah. It's a big bet.
Now, I'm curious though. I'm really curious what AVGE, because of its global exposure, what it
has to those top 5. It'll be
in those top 5.
I'm going to make a bet here. Let's see. I'm going to say if it's 12 in AVUS, I will say it's like 7% in the global. I mean, it's still going to make a large part because still globally it does.
You know what? I can't find it because although you're right, because 45% of AVGE is AVUS.
So you already know you got
15% is Avantis large U.S. growth. So you've got
it's going to be about
60%.
About 60%.
So it'll be 7.5%.
Like that, yeah.
About 7.5%. You're pretty good.
Thank you. I'm on today. So, I mean, the thing is, again, concentration risk is a huge risk. People have forgotten how painful it was, for example, in 2000 when you had massive risk as well with holding few companies.
That is the thing. The risk of holding a few companies is much higher than the risk of holding many in terms of default risk. You're still going to get volatility. You've got to live with that, and we will return momentarily. And the Talking Real Money radio show and eventually podcast continues. Now, this one was pre-recorded for broadcast at this time because are you still in Puerto Rico right now?
Thank you, Don.
When are you going to be in Puerto Rico?
It's great to be here again on the show.
Yeah, you're not AI. We've done an AI show, remember?
That was fun. Let's see. I will be there until I come to see you.
Like right now?
Yeah.
Oh, okay, so he's in Puerto Rico now.
I'm in Puerto Rico.
And I'm in New York City. Yeah, I'm in New York City. And you're there. We're glad you are there. And we want to tell you how much we appreciate you being there. This is a place where you can spend time talking with us about money. You can ask us questions on our show when it is live on Saturdays at 855-935-TALK, which will be next Saturday. We'll be live Thanksgiving weekend. Good time to call. Gather your family around the radio. Wait. Yeah, around the radio.
Much of tryptophan as you can, and then news off.
Yeah, and grab that turkey sandwich and give us all a call.
Okay, fair enough.
Well, I once had a caller on the old Don McDonald show who
still
fell
remember
asleep
that
on his
one. That
porch
was
swing.
funny. You cut to him every once in a while, like
this
listening.
Is what we heard, and you heard crickets in the background. He was asleep on the porch.
Pretty exciting program, I guess. Huh?
It was summer.
Okay, fair enough.
Summer. You can also go to talkingrealmoney.com, and on the contact form, you can either speak questions, record them, or you can type them in, and then we read them on future shows or podcasts.
You know what else you can do? You know what else you can do?
I was going to say, there's also another big event coming up.
This is huge.
Our biggest event ever.
Yeah, I mean, and this is number 11, I think. Do I have that right?
You're right.
Wow.
It's 11.
Crazy. This is something Don came up with, and I still think it's a bad idea, but we have to do it because he came up with it. I can't say no to him.
Excuse me. Have people showed up for
there
every
is that
one of them?
part of it, I guess. Okay.
Yeah, okay.
What are we talking about? No, not his birthday. No, not Christmas. This is RetireMeet 2025. That's right. Just around the corner.
More exciting than Thanksgiving. More exciting than Christmas.
The gift that keeps giving.
More exciting than President's Day.
Well, yeah. Okay. What about Columbus? Okay. So it's coming up, and you can now go to the website. You can see all the exciting speakers we have. And we do have a great, I think, maybe our strongest list.
I'm really excited about Joe Salsihai.
Yeah, from Stacking Benjamins, Paul Merriman of Paul Merriman. You got a Paul Lupescu of
Paul Merriman fame.
Of Dimensional Fun. It's 2/3 of a great day. I mean, I'm taking you and I off it.
Apollo's going to be there again?
Apollo's going to be there again. So
I love
Here's
Apollo.
the thing,
He's
all
so
joking aside, this does sell out very quickly. Last year we sold
the live one in Bellevue sells out very
sold
quickly.
It out by like the first week of the year or something. It was crazy.
Yeah, we did. It was like in January, which is funny because every year for 11 years, 10 years, Tom has
I'm still doing it.
Stewed.
I know.
He just gets so anxious. Well, is it not going to sell out this year? This will be the first year it won't sell out. We better get it. No, Tom, it'll sell out.
We haven't even given them the date yet. It's Saturday, February 8th, 2025 at the Maidenbauer Center. You can register now. You do get early bird tickets, which I should know the cost.
Are they on sale?
They're on sale
cheaper?
now. They're less expensive. I think it's $20 a head or something. It's inexpensive when you consider all the food you get. You get breakfast, you get lunch.
Just come for the food.
I know. We've said that before because the sandwich is delicious.
I am so bummed. The people at Appella killed off RetireMeet.
I know. Oh, they did. That's gone now. You can't get your meat anymore on Saturday.
I had both domain names pointing to RetireMeet, and they got rid of it.
People thought it was a place where seniors met other seniors or something, so they had to take that down. Exactly. So Saturday, February 8th, we will both be there. Yes, we'll be doing the show. Jess, Joe, and Paul and Apollo.
All right, we have to go now. They're going to run us out of time.
So join us. RetireMeet.com.
RetireMeet.com.
Sign up now.